Let me give you three numbers. Number 1, $75.96. That is where silver is trading right now, April 25th, 2026. Down over 2% on the day alone, down nearly 4% across the past 5 sessions. The paper market is selling it hard. Number 2, 836 tons. That is how much silver China, the single largest silver consumer on the planet, imported in the month of March alone, not the whole year, 1 month. A number that is 173% above the 10-year seasonal average for March. Number 3, 762 million ounces. That is the total volume of physical silver drained from global above-ground stocks since 2021, 5 consecutive years where demand consumed supply faster than the earth could replace it. The Silver Institute just confirmed a 6th straight deficit is already underway in 2026. 3 numbers, 3 completely independent data points, and every single one of them says the same thing. The physical silver market is tightening in a way that the paper price is not acknowledging. That gap between reality and the price tag is what we are going to dissect today, with precision, with verified numbers, and with the institutional context that makes this moment worth paying close attention to. Let's get into it. When a precious metals newsletter says silver is going to $300, most serious investors scroll past it. That is noise. That is clickbait. That is a business model built on selling excitement. When Bank of America's head of metals research publishes a formal institutional research note saying silver could reach between $135 and $309 per ounce before the end of 2026, that is an entirely different category of statement. His name is Michael Widmer. His title is Head of Metals Research at one of the largest financial institutions in the world. His forecast was not posted on a blog. It was not tweeted. It was published in a research document that carries liability, institutional review, and the full weight of a bank whose derivatives book dwarfs most national economies. So what is the actual methodology behind those targets? It is not magic. It is not speculation. It is ratio mathematics applied to observable market data. The framework is the gold to silver ratio, the number of ounces of silver required to purchase 1 ounce of gold. Right now, as of this week, that ratio sits at approximately 61 to 1. Gold is trading near $4,700 per ounce. Silver is near $75.96. 61 ounces of silver for every single ounce of gold. Widmer's argument is not complicated. He is saying that ratio is historically elevated, and historically when it compresses, when it snaps back toward its long-run averages, silver dramatically outperforms gold. Here is the math behind both targets. In 2011, during the last major silver bull run, the gold-to-silver ratio compressed all the way down to 32 to 1 at its peak. Apply that ratio to gold's current price near $4,700, and the math produces a silver price of approximately $147. Widmer cites $135 as his conservative base case, using slightly more cautious assumptions. That is his floor scenario, a natural continuation of this bull market without any delivery squeeze or emergency. The second target, $309, uses the ratio from the 1979 to 1980 Hunt Brothers silver episode when the ratio compressed to roughly 14 to 1 at its most extreme. At today's gold prices, applying that ratio mathematically produces a silver price north of $330. Widmer explicitly frames this as a scenario that could happen rather than a central forecast. He is not predicting it. He is saying the structural conditions that would produce it are present. That is the distinction that matters. Bank of America is not telling you silver will reach $309. They are telling you the physical infrastructure exists for it, and that from current levels near $76, the asymmetry is extraordinary. An 80% move gets you to the base case. A 17% decline gets you back to recent support. The risk-reward math is built into the ratio itself. Widmer's team noted that silver sits at a unique crossroads between industrial and monetary demand, making it one of the more asymmetric bets in the entire commodity market right now. That word, asymmetric, is the language institutional investors use when the potential upside significantly exceeds the measured downside. They are not being reckless. They are reading a structural setup. Now let me walk you through what Bloomberg confirmed on April 20th and what the broader financial media has almost completely ignored in terms of its true significance. China imported 836 tons of silver in March 2026. The 10-year seasonal average for March is 306 tons. That means China imported 173% more silver than a normal March. Not 10% more, not 50% more. 173% above the decade-long baseline. To put that in context, if any major U.S. equity index delivered a monthly return 173% above its historical average, there would be no other story in financial media for weeks. Silver did that on the physical demand side in 1 month, and the paper price fell. Year-to-date through March, China's 2026 silver imports have reached 1,726 tons, the highest level ever recorded for any comparable period. China, which was actually a net exporter of silver as recently as 2025, has reversed completely into record import territory in 2026. Now let's talk about why, because understanding the cause is more important than knowing the number. The March spike was driven by two completely unrelated buyer groups acting simultaneously. The first group, Chinese retail investors. Gold reached nearly $5,500 per ounce in January 2026 before correcting sharply. Even at its current level near $4,700, gold is priced far beyond what tens of millions of ordinary Chinese savers can meaningfully accumulate. Physical metal ownership in China is not a niche investor habit. It is a mainstream savings behavior embedded in the culture. When the primary metal becomes unaffordable, Chinese savers do not abandon the concept. They move to the secondary metal. They bought silver bars. Retail bullion shops in Shenzhen's Shuibei market, the center of China's physical precious metals trade, saw bar sales surge to levels market participants described as extraordinary. Silver became the accessible monetary metal in a country where gold had become too expensive. The second group, Chinese solar panel manufacturers. On April 1, 2026, China removed export tax rebates on solar panels. That made finished panels more expensive to sell internationally. And every solar manufacturer with outstanding production orders had a powerful incentive to complete and ship as much inventory as possible before the deadline. Building solar panels consumes silver. The global solar industry uses approximately 20% of total annual global silver supply, and that production is overwhelmingly concentrated in China. When Chinese solar manufacturers compress months of production into weeks to beat a tax policy deadline, silver consumption spikes correspondingly and immediately. Here is the critical point. Neither buyer group knew about the other. The retail saver in Shenzhen buying a 100-gram silver bar was not coordinating with a solar factory in Guangdong ordering silver paste by the ton. Two unrelated demand forces, one monetary, one industrial, converged in the same calendar month and produced a customs number that is almost incomprehensible in historical context. Now, a fair analysis requires acknowledging something. Part of March's solar demand was borrowed from April and May. Manufacturers front-loaded purchases to beat the deadline, which means some of that consumption will not repeat in the near term. The question that matters going forward is whether Chinese retail investor substitution demand continues at elevated levels. Given that gold remains above $4,700, the substitution motivation has not disappeared. But here is what does not change, regardless of April's numbers. Every ton of silver that entered China's warehouses, solar factories, and retail bullion shops in March is a ton that is no longer available to the global physical market. It has been consumed. It is not coming back. Let us step back from the monthly data and look at the structural picture, because this is where the argument becomes most compelling and most verifiable. The Silver Institute, in its World Silver Survey 2026, published April 15th, confirmed that the silver market is heading for its sixth consecutive year of structural deficit. The updated 2026 deficit figure is projected at 46.3 million ounces, a 15% widening compared to 2025. Now let me be precise here, because this number matters. The Silver Institute's February preliminary estimate was around 67 million ounces. The April 15th World Silver Survey revised that figure down to 46.3 million ounces, as updated supply and demand data came in. That is the current authoritative number, 46.3 million ounces of demand that the global silver mining industry simply cannot fill in 2026. But the annual deficit figure is only part of the story. The more important number is what has accumulated beneath the surface since 2021. Since that year, 762 million troy ounces of physical silver have been drained from global above-ground stocks to bridge the annual gap between supply and demand. That is not the sum of accounting deficits. That is actual, verified physical depletion of the world's above-ground silver inventory, documented by the Silver Institute and confirmed through exchange warehouse data, 762 million ounces, roughly equivalent to an entire year of global silver mining output, gone from the buffer stocks that keep this market functioning. When demand outstrips production annually, The market bridges the gap by drawing down those above-ground stocks. Those stocks are finite. They are not being replenished at the rate they are being consumed, and new mine projects carry lead times of 7 to 15 years. There is no supply response available on a 1-year or 2-year horizon that can address a deficit of this scale. Meanwhile, physical investment demand is forecast to rise 20% in 2026 to a 3-year high of 227 million ounces. Western retail investors who largely missed the 2025 rally are now entering the market. After 3 consecutive years of declining Western retail demand, a rebound is underway. This is not a speculative narrative. This is the Silver Institute's own forecast, produced by Metals Focus, one of the most rigorous precious metals research consultancies in the world. Here is where the mechanics of the market become concrete and verifiable through public exchange data that anyone can check on the CME Group website right now. As of mid-April 2026, registered silver inventory on COMEX stands at approximately 76.88 million ounces. Registered inventory is the only silver that can actually be delivered to settle futures contracts. It has an active warehouse warrant. It is the real deliverable pile. Now here is the number that changes the picture completely when you understand what it means. Total open interest on COMEX silver futures, the total volume of paper claims outstanding, is 575.5 million ounces, not 173 million, not 200 million. 575 million ounces of paper silver claims against 76.88 million ounces of physical silver that can actually be delivered. That is a paper-to-physical leverage ratio of 7.5 to 1. For every single ounce of real, deliverable silver sitting in COMEX vaults, there are 7.5 ounces of paper claims against it. The coverage ratio, registered inventory divided by total paper claims, sits at 13.4%. Below 15% is formally considered stress territory by exchange analysts. The COMEX registered pool is not approaching stress territory, it is already inside it. Of that 575.5 million ounces of total open interest, the May front-month contract alone carries approximately 34,732 contracts, representing 173 million ounces of paper claims that must resolve against a registered pool of 76.88 million ounces. May 1st notice day arrives in 4 business days. The conditions that precede delivery squeezes are present now. Registered inventory in stress territory. Paper leverage at 7.5 times physical supply. China simultaneously absorbing record volumes of physical silver from the global market. The question that every rational person watching this should be asking is, if the physical data is this strong, why is the paper price at $75.96? The answer has 2 parts, and both of them are honest. First, COMEX futures pricing is driven by institutional positioning, dollar movements, interest rate expectations, and macro risk narratives. Right now, the ongoing Iran conflict, with the Strait of Hormuz still disrupted, is pushing energy prices higher, driving inflation fears, and strengthening the dollar. Non-yielding assets like silver face headwinds when real yields rise and when the dollar strengthens. The paper price today is reflecting those macro headwinds more than it is reflecting Chinese customs data published this week. Second, physical demand data and paper price can diverge for weeks or months before the gap closes. This is not unusual. It is structural. The physical market sets a floor. It does not set the daily price. The 836-ton March import figure from China has no direct mechanism to push COMEX spot prices higher immediately. What it does is drain global above-ground stocks, tighten the physical market, reduce the inventory available to satisfy delivery demands, and ultimately create the conditions under which the paper price must reprice to reflect physical reality. This is precisely the mechanism that produced the October 2025 London squeeze, when lease rates hit record highs as physical silver availability in the benchmark London market fell to levels that created genuine delivery difficulty. That event drove prices to their all-time high of $121.64 on January 29, 2026. The structural conditions that produced that squeeze were building for months before the price moved. Physical demand arrives before the paper price reflects it. The lag is real, but the gap closes. It always closes. Let me bring all of this together. Silver is trading near $75.96 right now, down over 2% today, down nearly 4% on the week. The paper market is responding to dollar strength, inflation fears from elevated energy prices, and Iran conflict macro headwinds. Bank of America's head of metals research has a published formal target range of $135 to $309, Both figures derived from documented historical gold-to-silver ratio compression levels, with gold near $4,700, applying the 2011 ratio low of 32-1 produces $147. Applying the 1980 extreme of 14-1 produces north of $330. Widmer cites $135 and $300 as his scenario anchors using slightly conservative gold price assumptions. Both are ratio mathematics, not predictions. China imported 836 tons of silver in March, 173% above the 10-year seasonal average, driven by two unrelated buyer groups: retail investors substituting silver for unaffordable gold, and solar manufacturers front-loading production before a tax deadline. Year-to-date 2026 imports of 1,626 tons are the highest ever recorded. The Silver Institute's World Silver Survey 2026 confirms a sixth consecutive year of structural supply deficit, with the updated shortfall projected at 46.3 million ounces. Since 2021, the physical depletion of global above-ground silver stocks has reached 762 million ounces, an entire year of global mining output drained from the world's buffer inventory. COMEX registered silver inventory sits at 76.88 million ounces. Paper claims against that inventory total 575.5 million ounces. That is 7.5 paper ounces for every real deliverable ounce. The coverage ratio is 13.4%, inside stress territory. May 1st notice day is 4 business days away. Two market realities currently exist simultaneously. The paper price near $76 is priced on macro narrative: dollar strength, Iran conflict, inflation fears, rate expectations. The physical data reflects structural reality: record Chinese imports, a 6th-year deficit, 762 million ounces of depleted buffer stocks, and a 7.5-to-1 paper leverage ratio on a registered COMEX pool that is already in stress territory. These two realities cannot coexist indefinitely. They never do. The history of this market, and of silver in particular, is a repeating pattern of paper price and physical reality diverging, and then the gap closing. Sometimes slowly, sometimes violently, the way silver moved from $80 to $121 in the final months of 2025. Here's what I want you to take away from this video. Not a prediction, not a promise, but a framework. Silver near $76 is priced as if the Bank of America research note does not exist, as if China's 836-ton March import record is noise, as if 6 consecutive years of structural deficit is routine, as if COMEX registered inventory at a 13.4% coverage ratio with 7.5-to-1 paper leverage is comfortable. The physical data says none of those things are true. Nothing in this video requires you to trust me. It requires you to trust the primary sources, and then ask yourself whether the paper price near $76 accurately reflects what those sources are saying. Bloomberg published the China import numbers. The Silver Institute published the World Silver Survey 2026. CME Group publishes the COMEX warehouse reports every single trading day. Bank of America published the research note. Everything is verifiable. Everything is public. The gap between the paper price and the physical reality exists. It will close. The only unknown is the speed. If this breakdown gave you a clearer picture, the kind of clarity that takes 3 separate data points and shows you how they connect into a single coherent thesis, share it with someone who is watching this market and trying to understand why the number on the screen does not match the data underneath it. I will see you in the next one.